And on today's show, how managing investment taxation can improve your client relationships. Really. Part 3 of this week's series on tax investment strategies with nationally recognized columnist Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmark. Let's get down to business. Welcome to day 3, Ken.
Hey, Stephen.
Ken, this is when I cherry pick a topic that I've seen more impact for advisors with their clients. This is a huge issue because I got so much mail back in January from my clients going, I just don't get this. I have a non-qualified mutual fund. I have a non-qualified ETF. I didn't do well in some of these funds. I wasn't told to do any tax harvesting before the end of the year. Now, all of a sudden, I receive my statement from the fund, and it's been a really great year, and my fund didn't do so well, which is a question right there. I'd question the choice of funds. But on top of getting a statement that shows a negative loss, about a week later, I get a 1099 for this loser fund. What's going on?
Well, in 2008, we really hit this strong when we had these huge losses and people are getting capital gain dividends and taxable income on 1099s. They're freaking out. And they should. It means that you have to be more judicious and careful about what you buy and when you buy it. What's happening is a fully managed typical mutual fund has 2 levels of potential taxation. There's what the fund manager does, which as they buy and sell stocks and bonds within the fund, they can create a taxable event, which then comes out as a distribution on a 1099. Okay, whether you actually receive the cash or not, in order to avoid being taxable as a corporation, they have to distribute this gain out. So what happened is those gains happened in earlier years. The money manager is now forced to liquidate assets because people are cashing out in areas times like 2008, and they recognize and realize the actual capital gain by actually selling assets. The other way you produce a gain is you buy the mutual fund, it increases in value, and you sell it and you create a gain there as well. Now, the good news is when you are taxed on that 1099, it increases your tax basis, so you're not taxed again. But it really kind of hits you in the face.
Ken, we're on this really cool document called Income Taxes Generally. It's off Backroom Technician. Again, you can order your 30-day free trial offer and get the same thing and look at it. I've been using it since 1992. I want to talk about these two because we're really in the portfolio area here. And you may want to let's just touch on passive for a second and then come back to what we really want to talk about, which is how we talk about taxation of open-ended funds, ETFs, static allocation models, things of that nature. Let's do this first.
Well, passive was Congress's way of shutting down tax shelters in the 1986 tax law. Basically, limited partnerships and rental properties and stuff that were being used to generate depreciation deductions and depletion allowances with oil and gas, that kind of thing, was flowing through this sieve, this partnership, into their personal returns and offsetting their ordinary income, salary, commission, stuff like that. Government didn't like that, so they created this new area. We hardly pay any attention to this anymore because there's really not much to deal with anymore. So we're really talking about capital gains and losses. We talked about a managed mutual fund, how that can hurt you. They turn their portfolio, they create a gain, they distribute out a 1099. So,
but before you go there, I'm just wondering why the public still, I know this, you know this, are we not talking about this at advisors? Because it is the greatest heated debate of consumers when they receive a statement of a loss and they get a 1099 for the same fund.
I don't know what all advisors do. I suspect the chances are they're really not talking about stuff like that. Now, your more advanced advisors probably are focusing more on ETFs or static models types of stuff, and are aware of this and are taking that into consideration. Those that are just using regular standard mutual funds, I'm not so sure how aware they are and whether they're doing their clients any real favors or not.
When you talk about taxation on an open-ended mutual fund, is that different from a regular fund? Why did you have the word open-ended?
Well, the open-ended is your standard mutual fund, what most people know. The ETF is exchange-traded funds are actually closed-end funds. They have a different mechanism for liquidation. They're pretty much sold like a regular stock. You can buy and sell them all day long. Mutual fund has to be priced at the end of the day, so if you put in an order, you can't sell a regular mutual fund midday. It actually closes out at the end of the day, and the mutual fund company, the open-ended mutual fund company buys
Is there
back
any
those
advantage
shares.
strictly on a tax basis then for open-ended mutual funds versus ETFs from a tax point of view?
Well, from a tax perspective, ETFs are attractive in that you generally buy an indexed fund. You buy a fund that actually buys stocks in the S&P 500 or one of the other indexes. And they buy it and they hold it. And generally, the only time you see any portfolio turn is like if Standard & Poor's changes who's in the S&P 500, which happens once in a while. They change out one and include another one. They'd be forced to liquidate those stocks and buy the new ones. That'll create potential a whole bunch of deferred gain if they've held it for a long time. So ETFs generally are much more tax favorable because they don't turn their portfolios. Another thing you can do is some of the software packages will tell you what the turnover rate in a mutual fund is. And the importance of that is not only that you're taxed currently, but if they're turning that portfolio rapidly, it becomes short-term capital gain. We don't get the preferred 15 or 20% tax bracket. The large majority of open-ended and managed mutual funds are short-term capital gains because they're turning the portfolio so rapidly.
We come back from the break. We're going to continue this discussion because this is really a good idea to bring to your clients and be proactive. Because tomorrow we're going to talk about how we're going to harvest this. We're going to walk through some of the basic concepts. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Again, we're on Backroom Technicians, income taxes generally. This is a sheet. Again, you can get your own 30-day free trial offer. And this is a really great mechanical thing to walk through. Now, we're not really talking about personal service, and we're not talking about passive because after you said, like you said in the first segment, after 87, pretty much this is all gone. There's really no real thrill for depletion allowance any longer. The kind of deductibility or depreciation, all these things are kind of, real estate, limited partnerships. They're not there like they used to be.
Well, they are, but in a different way.
Right.
They're for people that really are in the business of drilling for oil or really are actively operating real estate. For the passive investor trying to invest through a partnership and getting tax deductions against ordinary income, it doesn't work.
Little side note, I noticed that when I was looking at the provisional income test for Social Security, I saw a lot of that on there. Depletion allowance, preference items. I saw some strange things.
Are you talking about alternative minimum tax? Yeah. They go after those types of things.
Yeah, I noticed. And then again, people say, I got all these benefits. And then it said it hits your AMT, and then all of a sudden it hits your Social Security. I mean,
that's tax planning kind of went away when Ronald Reagan got into power, reduced the tax rates down to 28%, got rid of a lot of deductions. Then the 86 Act came and did away from passive income. So tax planning has kind of been in the background. It wasn't as much as at stake. Well, now with a 39.6% tax bracket, the 3.8% Obamacare tax, the whittling away of deductions and exemptions based on AGI, what's left? Well, we talked about that in our last show, and what's left is tax deferral.
I want to talk about this subject because a lot of people say, well, Steve, why are we talking about this since many people are buying mutual funds and ETFs in their qualified plan? So they don't have to worry about a 1099.
Right, that's correct.
But actually, I'm surprised, and I think you'll be surprised too, at the vast majority of these funds are not in qualified plans, are being bought by investors and people a little higher income, a little more discretionary money to invest, and that's in non-qualified.
Well, and I think basically the money managers of managed mutual funds believe that their sole objective and goal is to make as much money as they can for people. They're not thinking about the tax impact. Now, there are actually open-ended mutual funds that are fully managed that are advertised and managed as tax-managed mutual funds. They will actually do within the mutual fund the tax harvesting that we're going to be talking about. You can do on a personal basis.
Okay, so when you look at that and you're looking at because I'm just thinking in my head, I'm looking at the expenses of those funds. I'm looking at the tax management, which is good. I like that proactive. But I don't know if are those funds better than non-tax? You have to measure this all out, and I'm sure if you go to Morningstar, they'll tell you that.
Well, you can actually run software, especially like with the mutual fund companies themselves, that will factor in the tax impact and go back historically and apply the tax rates. But again, those are tax rates without all the other adjustments. So they're useful, but they're not perfect in a big way.
Well, one of the reasons we talk about taxes is because there are 3 products that have these tax advantages. We're talking about annuities, tax deferred, annuities with LTC linked benefits. Now, we talked yesterday, which was a surprise to many of our audience. Oh my gosh, I didn't know you could have a one-time transfer of your IRA into your HSA account and then pull that money out for medical issues, medical reasons for specific, without a tax off a IRA that was deductible. But now I want to talk to you about this. I'm curious about this. We went to the Thunderbird School of Management, and I noticed that so many people were in the Variable Universal Life seminar for one reason and one reason only, was to move their managed asset allocation model into the tax advantages of a TAMRA compliant contract, or if they didn't care about the at least deferral process with a modified adjusted or a modified endowment contract, which we're going to talk about Friday. Ken, when the wealthy are moving this way, and I looked at those numbers yesterday, I'm thinking the middle class is getting hammered here. I mean, people are moving towards life products because of these taxation issues. So I have a lot of people that are in non-qualified that are moving into our product line.
Well, you can play with spreadsheets all day long, and actually I did an analysis of variable annuities against cap gain assets, and as tax rates change and stuff, that changes. I saw Ernst & Young, one of the major accounting firms, did a full study of that, but you have to make so many assumptions of how often will the portfolio turn, that kind of thing. If they're really concerned about taxes, they have a couple choices. One is ETFs on an asset allocation model basis, where you buy static indexes and don't move around a lot or make changes, can keep your taxes down currently. Using variable annuities, variable life, indexed universal life, whole life, all that stuff. All of these assets have the ability to tax defer, and that's if deferral means you don't include it in gross income to start with. So it never reaches AGI or modified adjusted gross income. So there's your play. And you can do that with stocks. You can do it with tax benefited assets. But you also have to look at the tail end. Variable annuity has, or regular annuity, both of them have a 10% penalty before 59.5. So do your IRAs. Life insurance done right has tax deferral and tax free at the end. And of course, there's the cost of insurance that has to be factored in. But when you look at all the fees and management of mutual funds, then that may be even if it's a no load, you have an advisor who's managing that. If you have it in 401ks, you've got administrative fees, management fees, trading costs. You have to be fair in your analysis. And each of, tax deferral with cap gain assets like mutual funds, ETFs, as well as life insurance and annuities, these are all plays that can control what gets into gross income, which impacts AGI and MAGI. And that's why we're talking about this, is that's the new planning strategy. It's not the old deductions or passive deductions from real estate and oil and gas limited partnerships. That's gone. What we have left is tax deferral.
Remember, several carriers have the 1040 overlay, which is huge, and it really walks you through the mechanics of why the power of deferral can be so impacting for a client's 1040. Well, that's all we have for the show today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. Ken and I will see you tomorrow.